11 years. That's how long it took for my investment portfolio to hit 220k in value. And over the past 11 years, it hasn't always been plain sailing, as some investments went wrong, and in some years, the markets also performed badly. But as with everything in life, there was much to learn from the ups and downs of my investing journey. So let me lay it bare in this video. You might have heard of the saying, investing is a marathon, not a sprint. I cannot stress how important adopting this thinking is when it comes to building your own investment portfolio. Too many times, I have seen individuals investing in certain stocks or market instruments purely due to the allure of high returns, without understanding the underlying fundamentals behind their investments. Let me just say it straight. It's really rare for anyone to achieve overnight wealth through investing. Most of the investors' wealth will come from the years spent in the market. Also, by adopting a long-term mindset when it comes to investing and being mentally prepared for ups and downs, you are less likely to sell investments during periods of market downturns. Besides having the right mindset, consistent financial habits and adequate research are just as important. When it comes to financial habits, it's simply down to putting money aside consistently for investing. The easiest way to do so is by having a budget and allocating a fixed amount or a proportion of a monthly salary to be used for investing. With regards to doing research for investments, the type of research will be dependent on what you intend to invest in. If you're investing in ETFs, otherwise known as exchange traded funds, you need to not only know what the significant holdings of ETFs are and their respective industries and sectors, but also whether the ETF is actively or passively managed, along with their related expenses. If you want to invest in individual stocks and REITs, be prepared to do way more research, not just for the annual reports of the company, but also considering alternative viewpoints that go against your thinking about the company. The main aim is to understand as much of the company as possible before making your investment. However, no matter how much research you do, there will still be times your investments go wrong. After all, you never know what you do not know in the first place. Personally, I have had my own fair share of bad investments over the years, such as Singtel, Asian Pay TV Trust, and Lendlease Global Commercial REIT. While the feeling of losing money for these investments wasn't great, I still learned quite a lot from these experiences regarding what to look out for in future investments and what types of companies to avoid investing in. Of course, when it comes to bad investments, one can never avoid the topic of cutting losses. I know, cutting losses can be hard, as we all have an innate sense of loss aversion. However, it's important to cut losses when a company's results are continually poor or when its long-term future becomes bleak. By cutting losses, it allows the capital to be reinvested into better and more prospective investments. It also removes the mental strain of thinking about whether the share price will recover and when you should sell it. But what if I told you that there is a way to mitigate the potential financial impact of bad investments? The answer is just simply proper diversification. While many would think diversification is about putting your money into different investments, it actually extends far beyond that. To me, diversification not only encompasses investing in different assets or companies that correlate inversely with one another, but also relates to spreading out geographical risks. For instance, let's say you invest in a local Singapore bank, such as DBS. You're not diversifying your investments at all by investing in either UOB or OCBC, since they are all in the same sector and are affected by the same macroeconomic factors. Instead, you might want to diversify by investing in Sheng Siong or Nike, which are in the consumer staple and consumer discretionary spending sectors respectively. This way, your investment portfolio would be able to better weather through various macroeconomic conditions. Investing in companies that derive their revenue from different countries is also crucial in this modern day and age, where conflicts and geopolitical tensions are rife. We have seen how geopolitical tensions can have a direct impact on a company's business earnings. Thus, by having a globalized investment portfolio, geopolitical risks can be better circumvent, as we will still gain from investments in other unaffected countries. Besides diversifying through different countries, sectors, and industries, we can also better risk manage our investment portfolios by position sizing our investments. While this term is more common to traders, position sizing for investments is basically allocating different proportions of a portfolio to different investments based on your conviction levels and risk appetite. For instance, let's say you want to invest in the US market via the S&P 500 index, but ain't really comfortable with overseas exposure or its volatility. You can start with a small initial investment of say maybe 2 to 5% of a portfolio into the S&P 500 ETF. Once you have become more accustomed to the volatility and gotten more comfortable, you can then slowly look to increase the allocation to your desired levels. This principle also works if you are investing in individual REITs and stocks. By allocating a smaller proportion of your investment portfolio to riskier or lesser conviction investments, you'll be limiting your potential losses should your research not pan out as expected. Besides proper risk management, it's also crucial to invest in instruments that you're comfortable with and are able to hold for the mid to long term. Let's say you do not have enough time or interest to research individual stocks and REITs. It's perfectly fine to invest in an index ETF to at least capture the average market returns, or perhaps you're not ready to invest in the stock market. No worries, you can always start by investing in short-term government bonds and treasury bills. However, after a while, you definitely want to move on to investing in instruments that can potentially fetch you a higher return. This ensures that your investment returns outpace the rate of inflation. At the end of the day, building an investment portfolio that delivers positive inflation-beating returns is akin to assembling a successful football team. While a star striker could win you a few games, it's not a recipe for long-term success on a football pitch. You will need quality players in the midfield, defense, and goalkeeping departments to ensure that the team is well balanced, thereby increasing the odds of consistently winning trophies. Also, all football teams will make bad or poor player transfers at one point or another. The crucial thing is acknowledging it when it happens and moving on, so as not to affect the performance of the team. Lastly, there are many ways to win a football match. Some coaches advocate a more adventurous play style that is focused on scoring goals, while others prioritize a strong defense first and depend on counter-attacking as a tool to score goals. While fans might criticize the later play style as boring and uninventive, what matters at the end of the day is whether the team wins matches on the pitch. This is also what investing is all about too. As long as you consistently generate inflation-beating returns, it really does not matter how you do it. But know that as with all things in life, success will likely not come overnight, but will be a result of long periods of consistency and hard work. So with that, I wish you all the best in your investing journey.